Okay, peeps, welcome back. So today we're going to be talking about 5 methods to outpace and even destroy inflation. Let's get it. So the first method that we're going to talk about is reinvesting dividends into high yield ETFs. As you guys can see, I have Tesla up here on the charts. So here's what I mean by reinvesting into high yield ETFs. For those of you guys and girls that are new to the channel, YieldMax ETFs, which we talk about frequently here, are these right here. You can go to yieldmaxetfs.com to learn about it, but Tesla is currently paying a 49% yield. They're basically synthetic covered call ETFs that pay options premiums based on market volatility. So we're going to go to our handy dandy dividend calculator here, and we got Tesla entered. You got your individual stock, monthly distributions. We are going to reinvest the dividends, 69. Awesome number there. So how did we come to this number of shares? We basically took 1,000 divided by the current share price, which at the time was $14.38. As you guys can see, it's pretty close. And that's how we come to that starting number of shares. So what we're looking to do here is we're looking to be extremely aggressive in our reinvestment process here. Okay, we want this thing to grow as fast as humanly possible. So we're going to start out with $1,000 a month. You probably will end up having to pay taxes. It's probably going to be more than this, but we're just going to use this as the standard rate. The current yield, 49%, as you guys can see here on Tesla. No annual dividend increase amount. This could always change. Again, the markets are always changing. Options are always changing. The price of Tesla is always changing. We have seen that when the price goes up, the yield usually goes up, and when the price goes down, the yield usually goes down. So those things fluctuate with time. We'll give it a 1% increase in share price over the years because Tesla, we're extremely bullish on the underlying stock, which is Tesla. We think it could become a multi-trillion dollar company. Just our opinion. And we're going to invest for 10 years. And this is the result that you would get. So after the first year, you're making basically $500 a year, or about $40 a month. Second year, you're at about $500 a month. Third year, you're at, I'd say that's probably about $1,200 a month. Fourth year, you're sitting at about $2,500 a month, and it just keeps going. As you can see, the amount of dividends you would make and the end balance that you would have is pretty out there. It's pretty insane. So this is assuming that you were super concentrated, the share price remained the same, and the dividend yield remained the same. Again, I can basically guarantee that the share price and the yield are not going to remain the same. They're either going to go up or down. So we're going to go ahead and do another metric. We'll be even more aggressive. We'll say you put in $2,000 a month instead of $1,000. As you guys can see, the numbers are completely different. In year 2, you'd be at $1,000 a month. Year 3, you would be at about $2,500 a month. Year 4, you would be kicking down somewhere in the ballpark of about $4,000 to $4,500 a month. And it just keeps getting bigger and bigger and bigger. You get that snowball dividend effect over time. As you can see here, it grows pretty massive. So this is a way to basically just completely outpace inflation. And again, if we look at the chart of inflation, as you guys can see, it's pretty much gone down since the middle of last year. So you have almost an entire year of it going down. As you guys can see, these things don't ever really go down in a straight line or up in a straight line. So I kind of suspect that this is a pullback, and basically we're looking for a lower low at this point. So, you got your pullback here and then it drops. You got your pullback here and then it drops. So at some point this will go lower. And the lower it goes, the less hawkish the Fed is, which means that the stock market can have some room to breathe and rally. Tesla will go up. And as a result, the dividend will go up and you'll be outpacing inflation even more. So the current yield of inflation is basically 3.7% on headline. We take a look at core inflation. So I actually wanted to move this one to core inflation. It's 4.3%. As you guys can see here. So if we're going with the core inflation metric, that would be the 4.3% inflation rate. So just by being invested in these, you're already outpacing inflation by basically 10% on a year-over-year basis based on the most recent distribution rate. But if you add the compounding effect, obviously it would be way, way more than, or not 10%, 10 times. I mean, it'd be way more than 10 times. So that is the first option. The second option would be index funds. So the average return on the S&P 500 over the last 50 years has been about 10.74%. If all you did was invest in index funds and that's all you did month over month, again, if you're doing this in a retirement account, if you take, I believe, I'm pretty sure, and again, consult your CPA about this, but I'm pretty sure if you're in a Roth IRA, which is you put after-tax money into the account, so you can withdraw the contribution anytime tax free. But if you take out anything that is considered to be a dividend or gain, you'll have to pay taxes on that. But with all that being said, if you invested in index funds, did not pull your money out, and allowed the fund to grow, you would be making about roughly 10.5 to 11% year over year. Which again, as we can see on inflation, even when inflation was at the peak, you're still massively outpacing inflation by a long shot. Even on the headline inflation, you're still beating inflation by almost a whole percent. So it basically says, okay, so this is actually adjusted for inflation. The 50-year average stock market return would be 6.5%. But again, you're still beating inflation. That's kind of the whole point. So the example I'm going to use here is, in terms of price action, is the Vanguard Target Retirement 2065 Fund, or ticker symbol VLXVX. As you guys can see on the yearly time frame, it has gone up from basically, if we start out the year, it was at 27.25. And so you have all the way down to 25, all the way up as high as 29. So you basically get about $1 per share increase just on the price alone. This does not include the dividend. As you guys can see, the dividend is 0.51 cents per share. Share price is pretty cheap. The net assets under management, this is actually quite small for a Vanguard fund, believe it or not. $5 billion is pretty tiny, because Vanguard has like some 8 or 9 trillion in assets under management. But if you guys do the percentage numbers on basically $1 move to the upside when it's at about $28, you're already hitting about a 3% return in unrealized gains, not including the dividend. So if we go over to here to VLXVX, this is all the information you guys can see. The average return so far is 12%. So again, you're basically 3xing inflation here. The expense fees are extremely low. Vanguard's pretty notorious for this, for having extremely, extremely low expense fees. So if you're worried about paying a lot of money for management, you don't have to worry about it here. They give you all the metrics here. You guys can see their benchmarks. Basically what they're intending to beat is, I guess it would be the Dow Jones here. For this particular fund, you do have to have a minimum of $1,000 to invest in it. But then after that, you can just simply DCA in. I can tell you guys from experience, I know, because this is the fund that I have in my Roth IRA. And if we go down even further, you can see more metrics here. You can see that they have different funds here for this target date retirement fund. So you have the stock market, you have institutional shares, you have investor shares. So this would be like big money. This would be retail money right here. You also get exposure to bonds. It's 6%. I believe these are automatically rebalanced over time, meaning the older that you get, the more money gets moved into bonds versus stocks. And then you also have international exposure. This would be emerging markets, which is typically the most high yielding returns in the markets. And then you just keep going down. You guys can look at all this stuff for yourself, but you get a dividend too on top of that. So not only are you getting share growth, but you're also getting a dividend payment as well. If you have 100 shares in this fund, which is about $2,500, you'd get basically about $50 a year in dividends. It does add up over time. So the third one that I'm going to talk about with you guys today, and this is going to be a bit of a teaser into next month, because I did say I wasn't going to talk about this till next month, but I'm going to give you guys a teaser today. So the third option to outpace inflation, and this is based on crypto cycles, would be cryptocurrency. So let's talk about crypto. One of the metrics that I use to determine whether crypto is in a bull cycle or a bear cycle would be my EMA crossover golden cross death cross strategy. As you guys can see here, golden cross at 5,000. This thing basically moonshot. So if you had bought at the golden cross and you had just simply held all the way to the top, you would have made roughly about a 12x on your money. And once we got that death cross, game over at that point. It had already been dumping quite a bit. This double top here was kind of an indication that the market might start to dump, and that's exactly what happened. So that gives you a rough idea of how much you can make on that. 10x your money. Let's say you put $100 in, a relatively small amount. You get a 10x on that. You're looking at $1,000. So you basically just got 1,000% return. When you compare that to inflation, you basically beat inflation by like 330 times. Now, I'm going to take a look at one more example on crypto, okay? One that I actually missed out on in the original crypto bull run. So as you can see here on Decentraland, Mana, this is an altcoin. It, at the pretty much the absolute bottom, it was at about 3 cents a coin, and this thing went up to almost $6. Well, let's figure out how much that is. So you got $6 divided by 3 cents is a 200x. If you only put $100 into this and you made a 200x, assuming you knew exactly when to buy, exactly when to sell, you would have made $20,000. So you're basically making about a 20,000% return, or you're beating inflation by about 6,666 times. Okay, that's option number 2. Now, option number 3 would be swing trading. As you guys know, we do swing trade here at this channel. You guys have seen some of the trades that we've done. We've made some pretty good money on these. If I can get the chart to actually show it here. So you guys can see we bought in, we held, and then we made a pretty large profit. The usual amount that we put into these trades is roughly about 1 to 1.5K per trade. So if we had 1.5K on this, you guys can see we made roughly about 20%. Again, if you make 20% on a trade, divide that by the inflation rate, which will be generous here, and say it's 4%, you would still 5x your money. So 20% divided by 3, you're beating inflation by 6.5%. So we're going to take a look at an example actually of a trade, or a couple trades that you guys could have taken if you wanted to in swing trading. Okay. So we're going to pull up the chart here. Sorry, TradingView kind of does this when you go in between really large time frames. So let's scroll back here a little bit and let's take a look at when a really, really good trade setup would have been. So you got this downtrend line here. You can see it keeps getting rejected. So we got the golden cross on the MACD here, got the golden cross on the RSI after hitting oversold territory, which is a pretty good buy indication. What exactly would we be looking for a golden cross scenario here? So you get the golden cross here. We bought in here, so that's pretty much what happened. We obviously had to wait to take profit, but we could have bought at support. So we basically just buy in here at the golden cross. We DCA down, and then we wait for this thing to give us about a 20% gain on our money. So if we had bought at support, sold here at resistance before the earnings call, we would have made 20%. After the earnings call, we would have made 60%. So we're actually going to zoom out here and show you guys some pretty powerful trades that you could have taken. So you see, you get the golden cross here on the blue and the yellow line. The red line is for day trading, so we're not going to include that. So basically, I would have entered here at 460-ish. and you could have just rode the wave up. As long as the price action is above the yellow and the blue lines, it is considered to be bullish. And you could have made it as much as 70% on this trade. If we go back in time, you got another really good example here. This was last year. You get the golden cross on the blue and the yellow down here. We get in long. I suppose you could have actually closed your trade down here, but if you have a stop below this trade, we don't personally use stops, but there's a reason for that. You could have easily made 36% if you had held longer. You could have made as much as 86%. So there's that. So we're going to scroll back. We're going to give you guys another real live example of a trade we made. So POAI is another really good one. As you guys can see on the 4-hourly, we had the MACD cross, RSI cross, and basically we saw this thing kind of start to curl up, and we're looking at this chart thinking, okay, this thing's about to reverse off support. So basically you get your cross right here, you get in here, and you ride the wave up. If you had taken this trade, assuming that it stayed above the blue and the yellow lines, which it did this entire time, you guys can see it's just bouncing off of this, you would have made as much as 114%. Again, you're making over 100% more than inflation. So that is number 4. Number 5 that we're going to talk about today, which we're not going to get too deep into, is day trading. Okay, we have not talked about this previously, but we're going to talk about it now. So day trading. What we do with day trading is we day trade futures. Okay, this is what we do. I'm going to give you guys a very baseline example. This is not our entire strategy about how we day trade, but it's a pretty good example, I would say, of how we do it. So we're on the 3-minute chart. Basically, what we're looking for here is we're looking for a golden cross on pretty much all 3 of these. So you get golden cross here, golden cross here, golden cross here. And you get the break of this trend line from below. We're actually going to draw another support zone down here. So basically this whole thing, or I guess actually this whole thing right here, get this thing to actually move the way we want it to. This whole area right here would have been considered to be a reversal area on support. If I go over to the 15-minute time frame, you guys can see it much more clearly. Get your MACD cross, RSI cross, it's crossing back from being oversold, so that's a very bullish sign. You get this long wick followed by a huge green close, that's a pretty bullish sign off support. You can see this is much more concise in terms of movements. But we don't actually trade the 15. We look at the 15 as kind of a reference point. We trade the 3-minute. So anyways, enough of that. You get your breakout, you get your golden cross here. Our entry point would have been right here at 44.68. We'll call it 44.69. Get the move into resistance. If you had simply sold there, you would have made about 8 points. So for those of you guys who don't know what futures is, basically if you trade one contract to the micro, for every dollar move or point move in the micro MES, you're going to get $1.25 in profit or loss depending on which side of the trade you are. So on a 10-point, well, actually that wouldn't have been a 10-point move. That would have been a 8-point move. So we'll call it 125 times 8. For every contract that you had, you would have made $10. Now for the full size E-minis, which is the ES right here, it's $12.50 per contract. So on an 8-point move, you would have pocketed basically about $100. And again, if you want to trade futures, look into it. The only thing I can say about this is do not trade an expired contract. You will regret it. You'll get penalized big time as a result of doing that, okay? So if we take a look at the percentage move here from that entry to the top, you can see it's not really a big move. It's only 0.21%. You might be asking, well, how does that outpace inflation? Well, think about it this way. If you make an average of 3 profitable trades per day, you're getting 0.6%, okay? Futures markets are open 6 days a week. If you can manage to pull that off 6 days a week, you just matched inflation within a single week in terms of percentage gains. If you did that for a month, you would be beating inflation by 4 times. If you did that in a year, and again, trading's not perfect. If you trade, you will lose money sometimes. I mean, you guys can see the numbers here. It's pretty ridiculous. So, anyways, hope you guys enjoyed this content. Please like, comment, and subscribe. We'll see y'all later. Peace.